Hello guys, and welcome back to another episode. In this episode, we're going to talk about market structure for position technicians. So in episode 12 discussion, we're going to talk about the ICT market structure essentials, the higher time frame protocol, ICT market structure advanced, ICT advanced market structure with order blocks, swing projections for market structure targets, high probability trading versus low probability trading. So the first part of market structure essentials is how to find your way through price. The trap aspiring traders fall into is not understanding how to use time frames properly. Not understanding how to use time frames properly is already setting you up for failure. Understanding how to use time frames is an essential component of trading. However, the conventional way of using time frames is through a top-down approach. So this is going through the monthly, the weekly, the daily, the 12-hour, the 8-hour, the 6-hour, the 4-hour, all the way into the executional charts. There's a huge problem with this conventional way of doing a top-down analysis, however. This approach does very little in helping us become a consistently profitable trader, and instead, it causes trader paralysis. So why does this conventional way of top-down approach cause trader paralysis? Well, trying to make an accurate decision after going through 8 or 9 time frames does not give us a decision with complete clarity. Each time frame will have details that another chart will not have. So let's say that you're going through a top-down approach. You're going from the 8-hour to the 7-hour to the 6-hour to the 4-hour to the 3-hour, and then you see a fair value gap on the 6-hour, but you don't see one on the 5-hour. Then you see one on the 4-hour, but you don't see one on the 3-hour. The problem is that sparks overthinking and uncertainty. Uncertainty is caused from a lack of clarity, because you're not certain which one to use, and this causes overthinking, which then puts fear into your trading. So the problem with fear in your trading is, let's say you're seeing price hit your level now. Now that you have fear involved with your trading, you're going to second guess your moves, or you're going to become more hesitant. So all of this leads to a lack of confidence in your trading. And imagine the downward spiral that this could produce if it's happening every day, because that's just how you've been taught to do a top-down approach. So when emotions are now interfering with your trading, the accuracy of your decision-making process decreases. You might make a move you regret seconds later. You might mark it in and then regret it, like, oh, why did I do that? Or you might second guess yourself when there's a clear setup on the chart. Let's say there's an A+ setup on the chart, but now that you have so much emotions, lack of confidence and fear, you second guess yourself and you don't take it. So this is why the conventional way of a top-down approach doesn't work, and that's not how you want to find your way through price. We want to find our way through price with clarity. So our focus will strictly be on a framework of time frames based on our trading style. So let's say your trading style is a position trader. You'll have a select framework of time frames to focus on. Position trader doesn't need to focus on the 4-hour, or doesn't need to focus on the 1-hour. If you are focusing on the 1-hour as a position trader, then you're pretty much experiencing some type of fear on your position trade. If you're a short-term trader, a one-shot, one-kill type trader, You don't need to be looking at the 5-minute. So each trading style will have a long-term perspective, intermediate-term perspective, and a short-term perspective. And each perspective serves a specific purpose. So as an interbank trader, you must understand the relationship between all three of these perspectives, and then you will form a picture with complete clarity. So compare this with the conventional way of top-down analysis, where you're going through monthly, weekly, daily, 12-hour, 8-hour, 6-hour, 4-hour. We're not doing that, okay? As an interbank trader, we simply have basically three lenses that we view the market within, and that's a long-term perspective, intermediate-term perspective, and a short-term perspective. And with this method of doing things, you'll have more clarity with trading, which removes all the overthinking and the lack of uncertainty, which is lack of clarity. So you can be more confident in your trades. Your decision-making process is a lot more clear, and you just know what you should be looking at in general. So your executions will be improved significantly. The next part of ICT Market Structure Essentials is, what trader will you be? The first step is to find out what style of trading suits you. Now this is a journey within itself, and experience will play a key role, so you can't rush things. Only time will tell. But you can find out by just looking at yourself in the mirror and asking yourself some questions about yourself. How do you make decisions? Do you make fast decisions? What day trading might be for you then? Are you more slow to make decisions because you want to plan things out more thoroughly? Or swing trading may be for you then? Understand that one is not superior to the other. We're not competing against other traders to see who's better. We're just here trading to find a means to freedom. We are then using the market as a medium to extract great deals for financial independence. So it doesn't matter what another guy's doing, because his style of trading might be completely opposite from you, and it works for him. So if you can find great deals with a slower decision-making process, then stick to that style of trading because it's uniquely yours. You do not need to compare yourself with someone who takes a completely different approach to trading. That guy might be a lot faster with his decision-making skills, so he'll be on the 5-minute chart making trades. How to develop faster as a trader. Since we understand price is fractal, it's better to use the day trading approach to develop. So what does a fractal mean? It's just a never-ending pattern. If you see a fair value gap on the weekly chart, it works the complete same as a fair value gap on a 3-minute chart or 5-minute chart, because it's just a pattern that repeats itself over and over and over again. When you're finding your way through price though, you need to sort it out in long-term perspective, intermediate-term perspective, short-term perspective, because you'll see these fractal patterns occur over and over and over again on all time frames. And if you don't know how to sort your perspective on what to focus on, that's going to cause overthinking and uncertainty. But I digress. Back to how to develop faster as a trader. Well, you want to take the day trading approach because you'll get the feedback faster. You get feedback every 24 hours from a day trade rather than getting feedback every 2 to 3 weeks from a swing trade. You want to know exactly what you did wrong on a trade, feedback basically within 24 hours rather than waiting a whole week to get a result, essentially. So once you understand how to use long-term, intermediate term, and short-term perspectives, you can scale it up and down. So a position trader's long-term, intermediate term, short-term perspective would be monthly, weekly, daily. A day trader might be daily, 1 hour, and then the 5-minute. Right. But once you understand how to sort price, you can scale it up and you can scale it down. Also, in the beginning stages of developing as a trader, your focus should completely be on pattern recognition. Don't focus on trying to grow a demo account or live account. Don't rush into it, because you're actually doing yourself more harm than you think you are. Your focus should be on trading your eyes first to see the repeating phenomenon in the markets. Then you want to see these repeating phenomenon consistently. You want to see, okay, how can I find these repeating patterns to happen every week? Does it occur on Tuesday? Does it occur on Wednesday consistently? Then, when you can do that over and over and over again, you introduce demo account trading to build confidence. And then after you build confidence that, okay, I can grow a demo account, go into live trade. But this is a very important step, guys. Please don't skip it, because I wish I didn't skip it. I was in the rush of trying to make money as fast as possible, because I thought that you could become a trader within 3 months, and that's just not the case. That's rushing it. Ideally, if you follow the correct path, which is focusing on pattern recognition first, then finding out if it's consistent over a week, then demo, then live trading, you could become consistently profitable within 1 year. But if you skip that path like I did, it took me double the period to become consistent with trading. And I'll explain why. Okay, if you skip this step and you go straight into demo or live trading, you'll fall victim to the emotional chaos from trading, because you don't know what to do yet. You don't know which fair value gap works, which doesn't, when to enter the market, when to exit the market, how to frame the week, the weekly candle, the daily candle. You have no awareness of this yet, because you're still starting out. So if you're in a rush to make money after not even knowing how to have a proper trading plan, you're gonna fall victim to emotional chaos. Let's say you'll think to yourself, oh, that's a fair value gap, I'm gonna buy immediately. But since it's a wrong fair value gap, okay, you're gonna fall through emotional chaos. And if you keep doing this over and over and over again, that's just going to lead to bad habits. And bad habits are tricky to get rid of, and that's why you end up taking the longer path instead of a faster path. So in trading, what seems like the long road of focusing on pattern recognition, then demo count, then live trading, that seems like the long road, but it's actually taking the faster road in the grand scheme of things. So do not rush the process and try to make money fast. This is not a get rich quick scheme like all these marketers on YouTube would tell you. Okay? Well, they don't tell you, by the way, but they market it in that way. This skill takes effort to learn, right? So treat it that way. Each trading style has its own unique set of time frame. The short-term, intermediate-term, long-term perspectives are time frames that the trader leans back on to create an initial foundation for clarity in price action. So each time frame will serve a specific purpose. Long term gives you an outlook, directional bias. Intermediate term gives you key highs, key lows to frame premium and discount. Short-term perspective shows you how to enter on those trades with a given time theory, basically a kill zone. Your goal is to properly understand the relationship between these three perspectives and start wiring your brain to view the story of price action with these three perspectives. Okay, so you want to blend long-term perspective, intermediate-term perspective, short-term perspective, and form like a story, and you want wire your brain to view it like that. And sometimes that story will tell you not to do anything in the markets. That's when you don't see anything clear, and it probably means that the markets are low probability, which you don't want to be involving in. This is when you must instill patience as a trader, unless you want to force a low probability trade that you will regret seconds later. And if you fail to respect the initial foundation of these time frames, and you see yourself consistently going back to the conventional way of viewing price, which is a top-down approach, what you're doing is you're trying to find a trade instead of letting it come to you. And the problem with this is you're forcing your will upon the market. And you probably might have experienced yourself, but whenever you try to force your will on the market, you're going to get punished. Because forcing your will upon the market is basically confirmation bias. You're finding things in the chart to support your bias, to confirm that bias you have, and you completely disregard what could go wrong. If you don't see any setups found within the long-term perspective, the intermediate-term perspective, or short-term perspective, okay, within these initial time frames, it means there's no trade for you. And now you know, okay, when I stay out the markets. And this is a skill to preserve equity. Because professional traders, that's the most important thing. If you're trading with risk the size of 4 digits or 5 digits, you want to make sure that your risk is in the correct climates. It's just like any business. You don't want to start a business where the risk is high, like COVID, so you're not going to start a business then. But when the economy gets back on the good side, then you want to put your risk and start a business. Just view the same thing with trading. Okay, trading and business is exact the same thing. So stay out the markets when these time frames tell you there's nothing, and build that discipline skill as a trader and wait for the market makers to move price around, because it's only going to move when they want to make it move. Forcing your will upon the markets will do nothing, since you can't move price. Stay grounded and wait for better technicals if you don't want to regret your decisions in trading. Now let's talk about the perspectives, starting off with long-term perspective. The highest of our selected time frames will serve as our long-term perspective. So since I want you guys to start off with day trading, since you get the fastest feedback, our highest selected time frame would be the daily one, the daily chart. So the daily chart will act as our long-term perspective. Once a level from our long-term perspective becomes activated, this sets up trading opportunities. So you can see the daily low over here. Once this daily low becomes activated, you can see price hits a level from the daily chart. Okay, this sets up trading opportunities. And check out how significant the market moves when it hits a long-term perspective level. Okay, this is because banks and financial institutions execute on the daily chart. Okay, they frame their setups on the monthly and the weekly, but they execute their charts on the daily chart. So we can expect dynamic movement when price hits a level from the daily chart. We want to base our trades on levels found on the long-term perspective, since we want to trade with the parent order flow. So you can see over here that once the daily low gets taken out, since it's bullish, price gets bought underneath the daily low. This activates the parent order flow, and we want to trade in sync with the parent order flow, because that's where the market makers are pushing price. If we're trading against the parent order flow, this means we're essentially trading against the market makers, the banks and financial institutions. So what I want you to do is think in terms of power 3. Once parent order flow has been activated by hitting a key level on the time frame, think in terms of power 3. Okay, you can see how the daily low gets activated here. Then once price gets activated, once parent order flow gets activated, look at the power 3 for each candle. This makes it very easy for us to day trade, since we all only have to wait for price to trade underneath the daily open here, and we're going to be a buy underneath daily open. So as a little study, you can count how many days that works out and how many days it doesn't work out, and you can just essentially create a win to loss ratio just off of that alone. Look at the moves here. You can see price opens, trades below daily open. That's when you want to be looking for a buy intraday. Repeat here, repeat here, repeat here, repeat here. Maybe get stopped out on this. You got this one. Maybe get stopped out on these two. Doesn't matter. In the grand scheme of things, you're profitable. The long-term perspective gives us a draw on liquidity. So what we want to do is, we'll talk more about draw on liquidity in a bit, but essentially it's opposing liquidity pools and opposing imbalances. So if order flow gets activated here, where is the opposing liquidity pool? We have swing high here, then we look to the left, we have more swing highs, and they're clean. So we can say that's the short-term draw on liquidity. After price takes out those clean highs here, we look to the left, where can it trade to next? But we have an ordered balance there, but we have some clean highs here. So that's the next draw on liquidity. And you can see our price seeks draw on liquidity, but we can base a draw on liquidity off a higher time frame level here. After price takes out these highs, what's next? Well, you have an ordered high. You could have drawn an opposing order block here as a target, but just take a look at how price takes out old highs and has no willingness to reverse at all. When we know where price is heading, the draw on liquidities, we can start looking for evidence on price heading towards it via subordinate order flow. So subordinate order flow is just the little peaks and troughs on the lower time frames generated from the parent order flow. Since the parent order flow is just going to be smooth, because it's a candle close every 24 hours. So daily close, daily close, daily close, daily close. Subordinate order flow on the 1 hour shows us a close every 1 hour. So we get more data, but it's subordinate to that daily order flow there. So what does this look like? We could see displacement heading towards each draw on liquidity. So you have draw liquidity here and draw liquidity here. check out how price is aggressive whilst heading towards it. You have impulse here, impulse here, impulse here, and impulse here. Each of these legs have imbalances, hence the displacement. Evidence also comes in the form of levels opposing the parent order flow breaking. So here's the parent order flow. What levels do we have opposing it? We have fair value gap here, gets broken here. These fair value gaps here, it gets broken here. This order block here gets broken here. Okay? Whenever you see your setup not working out, it's pretty much because you're playing against the parent order flow. So high probability trading is when we're trading aligned with the parent order flow. So here's where the parent order flow started. Okay, when you have a high probability trade, you'll see the market trade in your favor aggressively. So if you take this fair value gap aligned with the parent order flow, you can see our price trades aggressively up. Okay, this fair value gap here aligned with parent order flow trades aggressively up. This order block paired with this fair value gap makes it a high probability order block, trades aggressively up. And you can do this as well. Same thing goes for lows. Okay, when price takes out liquidity, how do we react when price takes out the liquidity? Do we have a aggressive reaction up? Yes, because this is trade aligned with the parent order flow here. Low probability trading is when we're trading against the parent order flow. So the parent order flow is here, price wants to go up higher. Okay? If you're trying to short against the parent order flow, even though there's a fair value gap, even though there's an order block, they're not going to hold since they're low probability. When you have a low probability trade, you'll see price be lethargic at your level and ultimately break your levels. So you can see here, if you're only focusing on price patterns, you're going to fail because you're going to not identify where price wants to go. So if I just identified order block fair value gap here, even though this pattern works and it's very precise, the most precise pattern ever, if you're trading against parent order flow, the pattern's not going to work. So you can see here, it has an initial drop, but it's just to fill the imbalance here, which is with the parent order flow. Then you can see it break, hence ultimately break your levels. We have a fair value gap here. You can see that this fair value gap, price trades lethargic. There's no selling at the level being occurred. And then you can see ultimately it breaks. Order block fair value gap here. Beautiful pattern, okay? But since it's against parent order flow, price just trades lethargic and then it breaks, seeking this draw on liquidity, which is this red line here, and these clean highs here. So everyone who thought this is going to be a lower high here, their stops are going to be placed above here, and the market is just going to trade aggressively towards that point. You have order block fair value gap here. You can see price reacts to it because it is a significant level, right? But they're expected to break. Okay? Order block fair value gap here. If it's against the parent order flow, it's going to be expected to break. Same thing here. So what you want to do is make sure that you're always trading based that long-term perspective. Otherwise, you're going to get chopped up in the intraday charts by shorting levels. In this example, by shorting levels that look nice, look very clean, look textbooked, but since they're trading against the parent order flow found on the long-term perspective charts, they're expected to break. You want to be trading high probability, which is identifying the parent order flow on the long-term perspective charts, then trading in that direction. And you can see that your trades will pan out in favor most of the time. And if it doesn't, you take a small loss. Doesn't matter, because the next win is right around the corner. So with that being said, let's talk about intermediate term perspective. After a trading level from the long-term perspective is activated, we can start looking for more definition with an intermediate term perspective. An intermediate term perspective is the middle time frame, okay, between short term and long term. You can see that as we go lower in perspectives, price action becomes more detailed, because the long term perspective requires more time to close that candle. For instance, a weekly candle takes 5 trading days, or a daily candle takes 24 trading days. So it's very smooth. But the hourly, or for a short term, a 15-minute, it's going to be more definition since they close a lot more faster. And the more definition allows us to see order blocks, imbalances, swing highs, and swing lows. You'll see that the imbalances occur way more on the intermediate term perspective and a short term perspective. With more definition, we can now see how price reacts to the long-term perspective levels. Focus on 3 things: market structure breaks, imbalances, and institutional sponsorship. So you can see over here, this is where the parent order flow was activated, because it's a long-term perspective level, right, from the daily chart. We can see how it reacts with a market structure break. That confirms that the parent order flow is now active. What else confirms that the parent order flow is now active? Well, we see displacement in form of an imbalance. Okay. What about institutional sponsorship? Well, we can see that parent order flow still remains active if supports start holding and down close candles start holding, which are order blocks. You can see order blocks are holding, and look to the left. Up candles are being broken through, so all resistance levels are breaking. Here, fair value gap here gets broken here, so the institutional sponsorship is bullish. So just to make institutional sponsorship easy to understand, you want to see support levels holding and resistance levels breaking. That's it. We can also start refining dealing ranges to show us if the price is overbought or oversold, and we don't need to use an indicator for this. So the clear dealing range is here, from this high to this low, and you can see we're in the discount compared to this higher range. So price is clearly oversold, and it's recently acted off a long-term perspective level. You could also use this low to this high to see when price is in a discount. That's where it became oversold as well. But the main focus is in this entire range. The green shaded area is where price is really oversold. Identifying dealing ranges allows us to find internal range liquidity targets. So what we want to do as traders is we want to buy in a discount and sell in a premium. And a premium can come in 2 forms: internal range liquidity and external range liquidity. Okay, so we have this old high here, so we could buy the discount here, exit that internal range liquidity from this range low to this range high in the form of buy side liquidity here. Or we could buy along here and target internal range liquidity in form of this opposing fair value gap. Okay. The intermediate term perspective allows us to manage the long-term perspective with more detail. Okay, so if you want to know long-term if that level is going to hold and if price is going to continue to draw towards the drawn liquidity, we can manage that on the intermediate term perspective. And how we do that is we focus on if institutional sponsorship still remains bullish. So institutional sponsorship again is supports, holding, resistance, breaking. We want to see that continue bullishly if we have a bullish level from the long-term perspective here. So imbalance here. Does it remain bullish? Yes. Down close candles. Does it remain bullish? Yes. Okay. We want to ask ourselves this question over and over again. Does it remain bullish? Yes. Gap here remains bullish? Yes. Here? Yes. Are resistance levels breaking? Apparently so. The fair value gap here, is it breaking? Yep, we just closed right above it. Okay. And you want to ask yourself, is institutional sponsorship still remaining bullish when we clear our drawn liquidities? Okay, so this is how you can manage the parent order flow. Did we take the draw liquidity and break down lower? No, we didn't. Institutional sponsorship still remains bullish, and we can see that in the form of imbalances holding, which is support. Down close candles still holding. Support, support. Highs being broken, which is resistance levels being broken. And if price did come clear out liquidity pool, how are we going to react afterwards? We can see that this entire move here is bullish because we printed false highs, which are clean highs here, and we didn't even take out the draw liquidity yet. So we want to see, okay, if price trades below lows, are we going to have a bullish reaction to it? That still shows us that institutional sponsorship is bullish. So for institutional sponsorship, you want to focus on 3 key levels, which is imbalances, order blocks, and liquidity pools. You can see here, after we clear the drawn liquidity, is institutional sponsorship still bullish? So we have an imbalance here, clears it, forms an intermediate term low here. Is institutional sponsorship so bullish? Well, we see resistance levels here breaking, fair value gap here breaking, clean highs here. What side of the market is being more aggressive? Are shorts being aggressive or longs being more aggressive? High probability trades with an intermediate term perspective. We want to wait for an intermediate term low to form, then participate on an entry afterwards on a short term towards a target. Short term will be discussed in the next chapter. But here, we want to wait for an intermediate term low to be formed, which will be discussed in episode 12. Intermediate term low form, and then we want to participate on a short term towards a target. So here is our first target. We are in a premium market. We have an internal range liquidity target exit here. So within this green shaded area, we can be a buyer towards it. Okay? And if this target doesn't show any signs of reversal because institutional sponsorship is still bullish, we can continue to target the next internal range liquidity target here. And you can see how institutional sponsorship still remains bullish. Okay, but high probability trades is waiting for a low to form and then on the short term looking for entries all the way to these targets here. You can see here another intermediate term low forms here. And we have a clear target, which is drawn liquidity here. So we wait for the low to form. and then we're looking for entries all the way into the drawn liquidity. Short-term perspective. So first, let's recap what we've covered so far. Okay, so the highest time frame, the daily chart, will act as a long-term perspective. This is going to give us directional bias, key levels to frame upon for parent order flow, and it's also going to give us the drawn liquidity. So on the near term, you can see the drawn liquidity is this high, and since we're comparing this high all the way to the left, we can see it's very clean. So that's going to be the short-term drawn liquidity, which gives us 1, 2, 3, 4 days of just having a bullish directional bias. So when we have a bullish directional bias, then we go intraday. When we go intraday, we have to think in terms of power of 3, and we're going to be buying below every daily open, which you can see here. Now we're on the intermediate term perspective, and now we can manage that long-term perspective with more detail. So that's where the parent order flow comes, but since we're on the 1 hour chart, we can see the subordinate order flow, which has more details in terms of imbalances, swing highs, swing lows for market structure breaks, and order blocks for institutional order flow. So that's how we can manage the long-term perspective level to see, okay, is actually sponsorship at the level, and is that sponsorship going to remain when imbalances are tested or order blocks are tested? And you can see yes, institutional sponsorship remains the same and resistance levels are breaking. So that says, all right, the daily low level is activated. So what we want to do is we want to combine both the long-term perspective and the intermediate term perspective to give us a picture. And you can see there's already a picture here. We have a D level that should provide a big move. We can see on the intermediate term perspective that the institutional sponsorship is remaining because imbalances are holding and resistance levels are breaking. So when we go into a short-term time frame, entries should be the easiest part. All we have to do is find an entry within a kill zone. So before we base an entry, first we need to wait for a intermediate term low to form, and then we're going to look for an entry on the short term. So intermediate term lows will be discussed in episode 12, but here we have a rebalance low here, and the first short term target would be in the premium market. Look to the left, we have a swing high and we have an order imbalance, okay, within a premium market. Okay, so just this move right here, that's already a day trade. We have a level to base our trade off, which is from the higher time frame long term perspective. We have confirmation, institutional sponsorship. Now we're looking for an entry in the short term here. That's when we want to incorporate some time theory. So the first time theory we have is midnight opening, and this is to catch the low of the day for the daily candle, right? But first, since we're on the short term, we can start actually refining those levels found on the 1 hour chart, since we have even more detail on the 15-minute chart, right? So the lower you get into time frames, the more details would pop up, which means you'll see multiple fair value gaps. But this could be very overwhelming because you don't know which fair value gap to use. That's why we went through the long term first, the intermediate term, and then the short term. A lot of traders make the mistake and don't go through this process. So whenever they're on the lower time frames, they get chopped up. They see a fair value gap here, and it broke market structure after taking liquidity. Okay, that's your typical sweep market structure fair value gap pattern, but it didn't work, right? Why didn't that work? Because you didn't take into the account of the long-term perspective, intermediate term perspective, and not the short-term perspective. this setup did. Okay, so you have key level, intermediate term market structure break, intermediate term fair value gap, and now we're refining that fair value gap. The blue shaded area, that's the 1 hour fair value gap. We're refining it to this 15-minute fair value gap here, and you can see that's when you can get really precise. And you can also see, if you look to the left, we have a breaker pattern here. So we have a low, lower low, market structure break. That's a breaker pattern right there. So in terms of probabilities, it's crucial, it's very, very crucial to make sure that you're entering within a kill zone. Okay? If you're not entering within a kill zone, your trade's low probability. This is essentially because banks are going to move their price within business hours. If you had a shop and you're selling ice cream, you wouldn't be selling that ice cream in 4 in the morning or 3 in the morning. You would have your business hours around after school time, so like 3 p.m. That's when you would start selling your ice cream. It's the same thing with how these markets move their currencies. They have business hours that you must operate within, and if you operate with outside of those hours, then you're not following the banks. So that's why, on the short-term perspective, if you want high probability trades, it's really crucial that you're entering within a kill zone. And this just makes it easy, right? Once you frame out the long-term perspective, intermediate-term perspective, and now you're on the short term, all you have to do is be active within those hours and look for characteristics. London's characteristics is it tends to form a Judas swing. So this is a Judas swing. If you're not a buyer there, you can wait for London close to be a buyer there, and you can exit at the high we projected. And when your levels are correct in terms of long-term perspective level and an intermediate-term perspective level, you would see confirmation with intermarket analysis. Intermarket analysis is essentially you comparing this asset to correlated pairs. So the correlated pair on the bottom is the Euro USD, and since it's correlated negatively with the US dollar, you can see we have SMT divergence, which acts as confirmation, which just makes this trade even more high probability when you're trusting this fair value gap on a buying basis, right? So just look at all the factors that make this trade, long-term, intermediate-term, and all these short-term little tools and tricks to make your trade even more high probability. If you did trust this daily O, short-term perspective can give you so many more factors to trust it. So you can put a buy entry there, stop below there, you're entering within the kill zone, targeting there. That's one setup. But since we know that institutional sponsorship remains, okay, we should see buying on gaps or order blocks, or when price takes out liquidity, price should quickly snap up above it. It's the same thing here. You have clean lows here, price takes it out, you have a quick rejection up, forming a gap. We know that a gap blended with an order block, the last down candle before upwards move, it's a high probability order block. So if you didn't get an entry below here, this is the little scalp you can take. But if you manage to get both of them, well, what you can do is you can pyramid the setup. So you can have a full risk here, then half risk there, taking off there for a total of 3.6 R. Okay, so never be discouraged when your trade is 2R. That's great. It's absolutely fine. I don't believe in trades that are 20R or 30R or 40R, because that's assuming that you're putting your stop right below there, which is, it's not ideal. Maybe if you're risking peanuts to trade with, such as if you're trading with $30 per stop, which, you know, everyone has a starting point, but I understand a $30 stop loss wouldn't affect you psychologically and it wouldn't hurt your bank account that much. But if you were trading with a stop loss that was worth like $5,000 or a $10,000 stop loss, there's no way you're using a 3-pip stop loss when you're risking $10,000. It doesn't make sense. So every professional trader understands that they want their stop in a logical area, such as this low, which shouldn't be invalidated. So they can have peace of mind that, okay, if I'm risking a $10,000 position, I know that my stop loss is in a logical area. Compare that to a 3-pip stop loss. Just doesn't make sense. But I digress. So now let's talk about incorporating other time frames in conjunction with your framework. So the framework we've been using is a day trader's framework, which is the daily, the 1 hour, and the 15-minute. Those are the three time frames for the day trader's framework. But let's say that your long-term perspective is very unclear at the moment. Okay? Well, this is when you have to be flexible and you can adjust your long-term perspective in 2 ways. For the long-term perspective, I like to well, first of all, let's explain this chart here. So a lot of traders have trouble because they don't know which trading range to use. Okay, so do I use this low to this high and this order block? Do I use this low to this high and this fair value gap? Or do I use this low to this high and this fair value gap? Which one do I use? Okay, you can see how this is already causing what we said, trader paralysis. You already question yourself too much in an unhealthy way, which leads to overthinking and could lead to fear. Okay, so that's why we want to be flexible and adjust our time frame. What about here? Okay, same thing. Do I use this low to this high, this fair value gap? Do I use this low, this high, and this order block? Or do I wait for this entire high low to form in this discount here, and this order block fair value gap, which looks pristine? Which one do I use? Okay, so when you're having these questions again, be flexible, and the method we want to do is we want to shift up a scale. So we want to shift up a scale in time frames. So that would mean if I'm using the daily chart as my long-term perspective, I'm going to shift up to the weekly chart, and I'm going to use the weekly chart to help me identify some key levels if I can't see them on the daily chart. So the first one is these 2 down candles before the upwards move. That acts as one order block. And you can see in this trading range at equilibrium, we have a weekly fair value gap here. Okay, so that when we do go back to our daily chart, we can refine those levels. Okay, so refining just means making it more precise. We can say, okay, within this order block range, what's the swing low that makes sense? Okay, we have this low to this high. Within a discount, there's an order block with a fair value gap. We know that's an A+ setup. That's where I'm going to base my trade off on. What about this fair value gap? Well, we can see that from this low to this high, this is in a discount. And if we refine the fair value gap, we can see it right here. Okay, so now after looking at the weekly chart, we can refine those levels on the daily chart, and trading ranges and key levels become more clear. So we know that once we have a weekly level and a daily level, the parent order flow is activated, and these just have big moves that happen right afterwards. So take a look at this move from this low to this high. These moves happen because it's generated from a weekly order block refined to a daily order block. So this source of price, there's a lot of orders there which can create a big move like this. It's the same thing with this fair value gap. These are individual days. Okay, so you have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days until you clear equal highs, which is a draw on liquidity. So within those 11 days, your bias is thinking high probability trades are only for longs. So whenever you go intraday, you're buying below the daily opens. You can see if you bought below daily open here, you're profitable. Here, here, maybe you get stopped out here, you're profitable here, stopped out here, profitable here, 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 and then that's where you end your bias, because we're taking out some highs. Then after we have made our long-term perspective clear, it's fine to go to the normal way of doing things, which is 1 hour and 15 minutes for intermediate term perspective and 15 minutes perspective. So just do the same thing as normal. Just follow your framework. Nothing has changed. You see here, parent order flow gets activated. Do we have confirmation? Yes, we have a break in structure. We can see that down candles are holding price and imbalances are holding price. Order blocks are holding price. Highs are breaking. Imbalances are breaking. So that's how we can frame our trades. Look to be a buy here, a buy here, a buy here, exiting at internal range liquidity, and just following the same protocol until we reach our draws on liquidity. So that's what we have for part 1 of episode 12. Now comes the action step. So this is what you should be doing and how you should be taking action on this episode. First of all, I want you to find out what trader you are. So I have a PDF included. It includes all the time frames you should be looking at based on what trader you are. So if you are a day trader, then you have a select few time frames that you should be focusing on. Then from that point on, I want you to stick with that style. And every time you log something or journal something, you know exactly how to journal. So you're looking at a long-term perspective, intermediate-term perspective, and a short-term perspective. And you're doing that every day when you're journaling your trades or for your study journal. So you have a level to base off on the long-term perspective. You have your intermediate-term perspective to give you more detail, and then entries are found in the short-term perspective. And make sure that every time you journal and log a chart, you have all the probability scenarios also. So I'll see you guys in part 2, where we discuss the higher time frame protocol.